Okay, in this tutorial, I'll be showing you a new symbol which is TXN. I'll just copy that and paste it in Google and click stock. And I can see Texas Instruments. And what I'll do is on the left hand side, you can see information from Google. On the right hand side, you can see information from Wikipedia. So let's see, the last sale or the stock price currently is 115.86 US dollar. Okay, I'll just copy that and paste here. And okay, that's fine. And the boom is, or when it was founded, it's written here 1951. You can see from Wikipedia 1951. So I'll just type it in. And the sector is technology. Okay, and I'll show you later where I got the sector from. And then there are a few ratios that you need to consider. uh, you just go to, I use, it depends what you use. I use Macrotrend website, and which is here. Then I just click in price ratios, I click in price book ratio, and I just pasted the symbol, or if you know the name, that's good. Click it here and I'll show you the price book ratio, which is right now it's 12.77. Okay, it's 27th June, it's 12.77, which is not good, because it means that the book value or the real value of the stock is uh, much lower than the stock price, which means that you're paying 12 times or nearly 13 times more than the price you should be paying for the stock, which means that you're buying very expensive stock, 12 times more than what it should be. In 2018 December, it's 9.86 times more. In 2017, it's 6.81 times more. In 2013, it's 3.84 times more. The lowest, or the near, like it's 1.66 times in 2008. And so that's not the ideal even, but still it's 1.66 times more than what it should be. And so that's the lowest that it's gone. So right now the stock is very expensive. Ideally it should be zero, which means you're buying for equal price as the stock should be. If I look at the debt equity ratio, I go to other ratios and I click debt equity ratios. And if I just have a look at that, I can just see that in March 2019 it's 0.59. The debt equity ratio, if it's zero point 0.5 or below that, that's ideal, because it means that the company is not running fully on debt, long term debt. So, debt is not very good for the firm if it's too much debt. If it's a lot more than equity, it's very bad, it's dangerous. But if it's very less compared to the equity, then it's not dangerous, it's secure to invest there, it's risk free, kind of. So, it's 0.59, which is, a bit above zero point 0.5, which is not very good, but still it's 0.59. But if I just look previously in December 2008, it was 0.48, which is ideal right now, because it should be zero point 0.5 or below that. Then it's 0.41. Then it's like, if I see the previous years, it's consistently below zero point 0.5, which is very good for the firm. So it started taking debt in 2006, and then there was no debt for like 2 years. Then in 2011 it started again, but still it has maintained throughout being lower than zero point 0.5, which is very good. But right now it's above 0.59, so you need to be careful right now. Then if just I just have a look at ROE, um, and it should be 8% or above that, which is ideal. So right now it's 56%, which is really good. And if I just see consistency, it's above 8%. Consistently, it's above 8%, which is really good for the firm. It means that that's doing very good in terms of giving the return on equity invested. So it's very good for shareholders. And you can see like it has never been below 8%, which is very good. Then if I see current ratio, I'll just click here, and it should be at least 1.5 to be safe to invest. Here it's 3.68, which is very good, that's really good. If I just see the previous one, it's been consistently above 1.5, so which is really good, which makes the company very safe. So it means it always has more assets than liabilities throughout the years, so which is really good. Then the dividend. So a company that pays the dividend, it shows that the company is doing really good because it makes enough money that it can pay off the dividend to shareholders. It gives extra money to shareholders, so it means it is generating a lot of money. So to check the dividends, you just type it in Google. You can just see dividend yield, and it's 2.66% it's paying, which is really good. So I'll just change that to 2.66, okay, instead. Then if you are interested to know that, the more information you have, the better. So if you want to know if it's the capital market of this firm, you can just see it in Google. You can see it's 108.7 billion market cap, so which is a big firm. It's in billion. And then the reviews you can see from Indeed and Glassdoor to see what employees have to say about it, because employees matter a lot because they work from inside. They can see the firm from inside. So it gives a lot of information. So I just see in Indeed, and I can just type in reviews maybe. And you can see the reviews. I'll just type it in again. Yeah, you have to match the symbol, the red symbol, because sometimes the companies have same names, similar names, and that's the symbol is right. Okay, that's fine. And you can see it's 4.2 reviews, and you can read through the reviews, the cons, and the stuff like that. And 4.2 reviews is really good. And if I just type that in Glassdoor, you can see from Glassdoor as well, and you can just see what the reviews are, and that symbol is same. That's in Google. It's four star, which means that's really good according to the employees who work there, which gives a lot of pictures. And if you want to have a look at the patents, you just go to website Justia Patents, and you just type it in search bar, and you need to make sure that the name that you type in is same. And because often the firms have similar names, I'll just take Texas Instruments Inc., and I'll just search that in this bar. And you need to make sure that the applicants, you need to ignore the inventors. You need to consider it on applicants, which means people who have the full right of this patent. So it includes Texas Instruments Inc., which is in 2012, in 1995, in 1999, in 2000. So there are a lot of assignees, including Texas Instrument, 2001, in 2010, okay, 2010, which is not very recent, but still 2000. So 2009. So you need to search that if you have any recent ones, like in 2019 or 18, because sometimes the firm will start, there's a lot of patents, I guess. Sometimes the firm starts, but you know it stops innovating. It don't have recent patents, which is not very good for the firm. So in 2006 it has patents, 2007, so nearly each year it's innovating. 2005, which is very good for the firm, because that's how it will strive through competition. And what else? So you can just go through that. It's a big list, so it will just make my video very long. So you just focus on, not that it has a lot of patents, but does it has recent patents. That matters a lot. And that's good. And then the management, I just want to show you one more thing. If you go to Yahoo Finance, and if you just click here, and I just type that, I'll just click on this TXN symbol, profile. Industry is semiconductors, so sector is technology. So I was telling you about that. The sector is technology. From here you can get industry semiconductors, employees, you can have a look. And the company that shows the full pay of this is more transparent, which makes it very ideal. So you need to make sure that it has shown all the pay of the key executives, which is very important because it makes it more transparent. You can search each consecutives in Google, in LinkedIn, or whatever to know more about it. So I'm just going through a little bit about it, but there's a lot that you can learn from here. You can go to conversation, read what people have to say, and stuff like that.